Welcome to the Morningstar Asia Outlook for 2023. I'm Caitlin. I'm a data journalist based in Hong Kong. Electric vehicles and the supply chains that service these cars have performed so much worse than the market last year. Why? And this hype for the names like NIO and XPeng over? We're asking Vincent Sun, equity analyst at Morningstar. Hi, Vincent.
Hi, Kate.
So shares in EV makers performed poorly in 2022. XPeng is down 80% year to date. Why is that?
Yeah, we think the underperformance is mainly attributable to two things. First one is we see a vehicle delivery slowdown in the second half of the year, partly due to the overall market slowdown on high base, and partly due to the each individual company's model cycle. And second, investors are getting concerned about the intensifying competition and pricing pressure in China EV space, with leading players like Tesla cutting retail price. So I think coupled with the overall market weakness and investors' reduced risk appetite, hence the share price underperformance for the EV makers.
Right, you mentioned the intensifying competition among EV makers. Do you think the underperformance has not ended yet?
Yeah, we remain positive on the sector. Companies like NIO, XPeng, Li Auto have completed or halfway through their model upgrade process, and they started to build cars on the new generation platforms with more advanced technologies such as cockpit intelligence, fast charging, higher level of autonomous driving, etc. The country saw 6 million new energy vehicles in the first 11 months this year, and NEV penetration reached 25%, which was previously the target for year 2025. So after sales doubled for 2 consecutive years, the growth rate for 23 will likely to slow down on high base, but we expect EVs to continue taking shares from gasoline cars. It's just that with intensifying competition in the space, investors need to be selective. We maintain our preference for NIO as the premium brands have held up well in price competition.
Right, so the battery making market is, though, quite consolidated with CATL leading the domestic market, but it has no moat. Why?
Yeah, battery directly affects EV performance, including the driving range, safety, charging time, and so on. But however, as batteries are becoming more commoditized, we believe battery suppliers lack sufficient pricing power and sticky enough relationship with the automakers to award a moat rating. While processing a larger capacity helps mitigate production costs, with raw material costs being the largest part of EV batteries, we believe there is little room for CATL to differentiate from others in the fast-growing battery industry. Along with the price competition, heavy capital expenditure, and preceding R&D expenses, we do not believe the company can retain excess returns on invested capital in the longer run.
So what is your forecast on CATL and other Chinese battery names in terms of capacity expansion and international business in the year to come?
Yeah, we expect rapid capacity expansion from major Chinese battery makers, both in domestic market and in Europe, to capture the significant growth opportunity. We forecast CATL to grow battery capacity to 670 gigawatt hours by 2025 from around 300 this year. The forecast also includes around 100 gigawatt hours at its 2 European plants in Germany and in Hungary. For CALB, the third largest battery supplier in China, we expect its capacity to expand by about 80% CAGR to 130 gigawatt hours in 25. The company also set up a plan to build a plant in Europe.
So lithium is critical to the batteries that power EVs. What is their growth trajectory riding on the same EV adoption trends?
Right. Benefiting from the rapid EV adoption, we see fast growth for both top line and bottom line for the lithium supplies this year, which are mainly driven by the elevated lithium price due to tight supply. For the next few years, we expect demand for lithium to remain strong, but price to come off from the peak level witnessed this year. So in other words, revenue growth for the names that we cover will be slower compared to 21, 22, as production capacity expansion being offset by the drop in lithium price. For Tianqi, we forecast around 80% 3-year CAGR for revenue and net profit during 21 to 24, and around 50% for Ganfeng.
Lastly, tell us your topic in EV manufacturer, battery maker, and lithium supplier.
Our topic in EV space is NIO for its premium brand positioning. The company has a relatively diversified model portfolio, and the starting price is above the major competition. We also like H shares of BYD for its strong plug-in hybrid model lineup, which could help defend against competition. For battery maker, our pick is CATL for its clear leadership position over peers, and it's dominating 50% market share in China. For lithium supplier, we like Tianqi for its self-sufficiency in lithium raw material supply that provides the company with low cost and reliable upstream support.
Thank you so much, Vincent. Stay tuned for more on the Outlook series.